Minisode 33 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everyone, before I begin today, I want to thank our sponsors. CME Group, Trading Technologies, RJO Futures, and Top Step Trader. Now today I spoke with two guests, Patricia Hemsworth, Senior VP Institutional Sales at Paragon Global Markets, and Samir Madani, co-founder of TankerTrackers.com. We began today's conversation by hearing their thoughts and market impacts from the U.S. withdrawal from the Iran nuclear agreement. Pat explains the difference between Contango and backwardation. They both give us insight on the potential loss of supply from Venezuela. Sam and Pat discuss U.S. and Canada's boost in production and exports. Finally, they both give us their thoughts on what traders should be expecting from the upcoming OPEC meeting on June 22nd. As usual, thank you all for listening, and please enjoy this episode. Pat, Sam, welcome back to the show.
How you doing? It's really a pleasure. Thank you so much for inviting me, and I'm really thrilled to be here with you and with Sam. Thank you.
Thanks, Anthony. Thanks for inviting me as well.
It's great to have two of my favorite oil experts on the show today. What I love about speaking to the two of you is you guys make things so much easier for people like myself to understand fundamentals. So I'm really looking forward to this conversation today, and I know that I'm going to learn a lot, and the audience is going to learn a lot. So I want to begin today's conversation with a topic that is really being talked about on every news station, Twitter, everywhere that there's media. They're talking about the effects of the U.S. withdrawal from the Iran nuclear agreement. So I'm really curious to hear what you guys think about this, and I want to know, and we're going to start with you today, Sam. What is the actual market impact of Iranian sanction assessments of how much crude oil will be off the market, and when will it affect the curve?
So if we look at the previous era of sanctions, there was about 1 million barrels a day that was removed from the market, at least from Iran. And back then you had the international community behind it. So you had the UN. Sanctions on Iran because of the nuclear story. Now, situation is a bit different, and the one who's driving this, of course, is the United States without the United Nations. So the impact of it might not be as large. However, the U.S. has some angles which they're going to try, and that is to put pressure on the insurance companies and the companies that deal with the actual freight and any partners who work with the Iranian oil production. Now, how much will be removed from the market from Iran's perspective? I wouldn't say it's going to be anywhere near 1 million barrels a day. I would say it's probably a third to half at very most. And there are now. What's happened since last time is that if you look at China, their intake of crude oil has just skyrocketed since then. If we look at a 5-year period, so in the latest imports report, there was something like 9.5 or 9.6 million barrels per day in intake. So that means that they are the number one crude oil importer in the world, and they bring in every single grade under the sun. From all corners of the world. And so if they now get a whiff from Iran that there is a discount happening, they will take more oil from Iran. just for that reason. And it's not just because it fits them geopolitically because they have a stance against the United States, just as Russia does, but also because it's a golden opportunity given the fact that oil prices are very high right now. And Iran has published its discount list for June, and it shows that they are offering $6 discount in the West, and eventually it will be even better for the East. So that's what's going on with Iran. I don't believe it'll be more than 300 to 500,000 barrels at most.
Pat, what are your thoughts?
Well, I'm pretty much on the same page. I looked at some of the assessments of various different analysts as we tried to figure out when these things were going to kick in, but the estimates are, on the low end between 100 to 200,000. I think that's kind of an outlier, but most of the assessments are about 500,000 barrels a day. So, it could even be a little bit less than that. Some have made it even larger. And I'm talking about 2018 right now. And so we're thinking that the front end of the curve should be a little bit under pressure, which is what is happening in the market right now. The front end of the curve should be slightly weaker. And then we'll start to see really the market responding, say, fourth quarter. And so, today actually we went into Contango in the first 2 months of WTI. So, yeah, I basically, agree with Sam. And, one point is that the U.S., Treasury has what they call wind down periods. It's a 90-day period and a 180-day period. In the first 90 days, there'll be a series of things that the U.S. will, put sanctions on, which are, Iranian trading of metals and different products and autos and some ability to use capital markets to float their debt. And then by 180 days, the U.S. is pretty much asking that, our partners wind down their activities with Iran. And, the kind of hard edge to all of this is that there's the possibility, which the assessment of how much of a loss of production there will be is to some extent a function of, will the U.S. slap secondary sanctions on people who are trading with Iran during that period?
Okay, Pat, I have a couple of follow-up questions for you. First, you mentioned Contango. I'm sure a lot of people heard that and did not know what it means. So can you please explain what Contango is? And secondly, you mentioned that we're going to see an impact on the market in the fourth quarter. So the trader in me is going, okay, look, I follow these fundamentals, but I don't trade off of them. But knowing that fundamentals are going to have an impact, or you believe they will have an impact more in the fourth quarter, right away I'm thinking, what's the trade opportunity there? So if you could talk to us about how you see the market being impacted in the fourth quarter.
Okay, if I start with the question about Contango and backwardation. The crude oil market went into backwardation, which means that the front end of the market is at a premium to the back end of the market. And just like yield curves, the curve could be inverted or it could be the opposite. And right now, well, we have been in a backwardated market for some time. And today, the first 2 months, June and July, dipped into Contango. And what this shows really is that there is a near-term heavy supply of oil that is coming onto the market. And, what Sam said, I think is reflected in this phenomenon, which is that there's discounting, there's heavy-duty activity that's going on right now before sanctions actually go into place. We have heavy U.S. response, to high prices. And so anyway, the near term is starting to weaken a little bit, and we see the back end of the market, meaning fourth quarter, when the full sanctions take effect, which is in November, you know, the point at which the market should really suffer the effects of reduced supply. So, yeah, most likely what we're going to see is a kind of flattening of the front end, and the back end being relatively stronger.
Thanks, Pat. Now, Sam, I want to go back to you and talk a little bit about Venezuela. I've been seeing a lot of tweets, a lot of news coverage on the potential loss of supply from Venezuela. How big of an issue is this, Sam? How big of a concern is this to the marketplace?
All right, so Venezuela sits on the world's largest oil reserves, even larger than Saudi Arabia. And they have production problems, and this production has dwindled over time, rather quickly over the past couple of years. And revenue-wise, it's not. I mean, they're only saved by the fact that the barrel of price is only rising. But given the fact that they are producing a very, I would say, lower quality because it's sour and heavy oil. It's sold at a discount to the global market, and the biggest intakers of Venezuelan oil are China, India, but also the U.S. Mm-hmm. And the U.S. needs it on the Gulf Coast. So Texas, Louisiana, these states, they need this oil because the oil that's coming out of the U.S. in higher numbers, shale oil, for instance, is light and sweet. So that stuff has to be exported.
Pat, do you have any insight on Venezuela?
Well, Venezuela is kind of a sad story, and it started with Chavez and some of the changes that he created in the oil industry and in the economy there. But basically, Venezuela is an economy which 90% of the economic activity is related to the energy business. And 95% of their hard currency foreign exchange is from PDVSA exports. PDVSA being the national oil company, and so what's been happening is that the socialist regime of now Maduro, who is the kind of successor to Chavez. Well, first of all, this is also a 100% import economy. They really produce very little other, goods and services in Venezuela. So they require importation of everything, of consumer goods, but also equipment and machinery and many, many goods. And their foreign exchange is dollars, and it is from the production of their crude oil and also their refinery, their refined products, which they have been exporting to the Caribbean and throughout the world. But what's happened started first with the sharp decline of oil prices in the end of 2014-15, and things became more and more difficult for them, and they had borrowed also huge amounts of money, so they struggled to keep paying their bondholders. But what happened was that they were unable to import all the necessary goods because they did not have the foreign exchange. On top of that, they had a sort of tortured system of price controls and foreign exchange controls, which caused terrible inflation. This is also while continuing with social spending. So the economy sort of fell apart, and gradually the ability to, as Sam correctly pointed out, the crude is very, very heavy, and it can't be exported in its natural state. It has to be mixed with what we call diluent, and which is either naphtha or a light petroleum product.
Which they import from the U.S., by the way.
Which they import from the U.S. Exactly, and so they import probably 150,000 barrels a day, or have, in order to mix with their heavy crude. But they've had problems with that. They've had problems with so many things because of the lack of funds, and gradually people, many different creditors cut off credit to them. Schlumberger left the country. Many trading partners abandoned them, and so now they're heavily indebted to China and Russia, to whom they pay, I think, about 500,000 barrels a day go directly to either both China and Russia for debt service. And they also consume quite a bit of products themselves internally. So, their ability to export has been going down and down. And so, socially, too, I think we could spend lots of time on what's happened there, in terms of the humanitarian crisis. But, the effect on the oil industry has been that the refineries are falling apart, and the actual production, the ability to produce, has gone down. And now what happened in 2007 is that ConocoPhillips had production assets in Venezuela which were nationalized. Yeah. So what happened then was that ConocoPhillips had gone to international court to try to get a settlement, and finally this was decided that there was $2 billion that Venezuela owed ConocoPhillips, and so ConocoPhillips went to the Caribbean and started to confiscate assets, including ships that were coming into the Caribbean, to Bonaire, for instance, a storage facility there. They seized vessels that had crude oil. They seized products in the Isla refinery. They seized products and also assets from the Curacao refinery. So this has radically disrupted Venezuela's ability to export. And, some experts on Venezuela are expecting that this could actually bring down production to around 1 million barrels a day. So bring it down another 400,000. So that's really significant. And at some point, we don't know exactly when this is going to all happen, but it's kind of a fat tail event that's been threatening to happen. But it looks like it's devolving right now. So
also, we saw on here at tankertrackers.com, we saw that some of the vessels made it as far as Cuba, and they're hiding in their waters. And of course, the ones that could just quickly sail from Curacao, which is very close to Venezuela, did so. So they're in their own maritime border, and that means that nobody's going to come after them. So that's where they're hiding right now, what they can hide. We can monitor them in real time.
So, Sam, you say you could monitor them in real time. Is that something people could see live on your website, or are you putting out notifications when you see changes in their movement?
We report whenever there's any big change, but we see we calculate how many barrels of this or that is aboard, and we put out our reports. We're going to automate that later on, but it's something that we're following right now. We're trying to get good satellite photos whenever there's a clear skies.
Yeah, and I know that you guys post a lot of those updates when they come about on Twitter, so everybody should be tuned in for that. Now, Sam, I want to stay with you for a moment here, and something you have been writing about on Twitter is U.S.'s and Canada's boost in production and exports. Talk to us a little bit about that.
Yeah, so past couple of years, I've been following oil. A lot of emphasis has been on shale and also on OPEC and how the two get along. And now we see that U.S. production has risen substantially. Even year to date, I believe I have the number here, 921,000 barrels per day increase so far in the United States. And we're not even in June. So it's jumping quite a lot year on year. And at the same time, exports of this oil has also risen quite a lot. So we're now up at 1.62 million barrels per day average for this year. That means that U.S. is in the same league as many of the OPEC member states, and there's 14 countries, and I think only the top five pull most of the weight. So U.S. is increasing on exports, but they can't increase too much right now because the infrastructure is very crude. Sorry about the word pun, but the issue is that there are no mature enough ports that can facilitate these larger vessels which they need, just as many of the OPEC countries have, the so-called VLCCs, or very large crude carriers. Those are the 2 million barrel super tankers. Now, there is the Loop, the Louisiana offshore oil port, which is well known for receiving these super tankers out in deeper waters, but they've only done 2 exports so far in their history, and they just happen to be in the past 2 months. And they both they're both heading towards China. One has arrived, and the other one is got lost in the middle of the Indian Ocean. Now it's continuing the trip. And but in order for the U.S. to boost the exports, they need to see more tankers leaving the likes of the Loop. And that's where Corpus Christi comes in as well, but that's years away from completion. So the issue right now is that U.S. doesn't have the capacity to boost further without having the infrastructure for it. And when it comes to production, we have kind of a linear growth right now. But of course, that has its limitations as well. And I'll let Pat go into that further. But I can say one thing more, and that is Canada. Canada has also very strong growth in oil production, but its exports are only going, for the most part, one way, and that is south towards the U.S. And they make it their way with that sour, heavy oil that they have, goes down to the likes of Texas, to those refineries there. Now, if they had a pipeline which could connect their production in Western Canada towards the Pacific, they in turn could make more money per barrel instead of spending a lot of it on the actual pipeline transfers and rail transfers. So they could make more money if they ship it off to China. But that means that U.S.'s imports will drop from Canada as well. So that's a national security issue for the U.S. So there's a lot of things to balance in this. And of course, U.S. requires 20 million barrels a day of oil and is only producing half that and has to import a lot from other parties. But yeah, Patricia, you can talk more about the U.S.'s oil production and how that looks.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account.
Well, Sam's explanation about the pipeline and the direction of crude is sort of interesting because people hate pipelines, and it's very hard to build them, and it's easier to produce the crude oil, apparently, than it is to actually build the infrastructure to move it. So the problems with Canada and moving crude oil out of Canada are replicated in the United States. Permian Basin is growing in leaps and bounds, the production, but the pipeline capacity out of the Permian Basin into the refining areas and eastward and south are very limited. And so what we're seeing right now is that being showing up in the spreads. So Permian Basin, kind of a gathering point, is Midland, Texas. And so people have been watching the differential between Midland, Texas and Cushing, Oklahoma, which is the delivery point for WTI. Anyway, it's gone to $13 discount. So that is a measure
Wow.
of the inadequate infrastructure that we've got in the U.S., and that actually limits the production capability or the production growth in the U.S. because you can't get it out. It doesn't make much sense to be producing at extremely high levels. So,
and the risk, of course, is that you end up a rise in storage if you can't export it.
that, and and there's also at a certain point the storage is limited as well. So we're kind of at the limits of our ability to move and store from these new producing areas. To a certain extent, the same thing is true in Canada because they also had huge discounts, to WTI for the same reasons, because the production had increased dramatically and because they had an inadequate capability to move it, and the Keystone Pipeline had a leak, and for a while it was moving crude at a very they had to repair it, number one, and then they had to move the crude at a lower rate of speed. So
Right.
There are a lot of logistical issues that are limiting production or they're causing challenges to producing and moving crude.
Correct.
And me as a listener who is a non-expert in this, I'm sitting there thinking to myself, you said, Pat, that people don't like pipelines. Have we not figured out a way?
Pipelines.
Have we not figured out a way to make pipelines yet? And also the other thing I can't understand is who takes advantage of these massively discounted prices that you're talking about?
Well, people try. This brings out the creativity in people. Okay, so you have people trying to figure out how to rail crude from these areas and putting it in trucks and moving it around the country that way. So it's just stimulating people's creativity and trying to figure out how you can get this very cheap crude oil and to take advantage of the differentials. Some people have said that U.S. is keeping. Some people have observed that the U.S. Refinery operating rates are very high, and to take advantage of however they can of the cheap crude. And your advantage is really one that's logistical. Can you move it? Can you move it through a pipeline? Can you move it through a truck? Can you move it through rail? Yeah, it's a challenge, but people do hate pipelines. They're the most efficient way to move crude on land. But we've seen with the Keystone Pipeline, the torturous process, that goes into approving one of these. And the Canadians are going through the same thing right now. They just hate, there's so much protest against moving, getting a pipeline that goes to the Pacific. So they're going through the same thing that we've been going through.
I frankly never understood really why. I mean, I can appreciate that the people would protest against the pipeline because of a spill and so on. But we saw the alternative what happened in Canada when there was a rail accident a few years ago.
Oh, sure, yeah.
And that whole train blew up and over 40 people were killed in that town. And I don't understand this trade-off. I mean, plus Canada is losing something like $100 million a day in potential revenue by shipping it at a discount south instead of west towards the Pacific, when there's a very, very eager and hungry customer across the water in China. So I mean, it doesn't make so much sense for me. And I'm not even I haven't even had more than 2 years of experience in tracking oil.
Yeah, well, a lot of times people aren't all that rational when they think through these things. It becomes like a religion, almost like we're not going to spoil the land. It really takes on a very, very passionate, environmentalist cast, and whether that's rational or not.
No, I mean, I can understand, because the Exxon Valdez, what happened 30 years ago when it was, and they don't want their habitat to be destroyed, and they have flyovers almost every day with the Coast Guard there to check for spills. So that's good, but if they do it right from the get-go with the pipelines, and they have some kind of Plan B solutions for everything, then I'm sure it will work out just fine.
Mm-hmm.
Yeah. I want to move on to a topic, heating oil. And Pat, you had told me Yeah, Pat, you mentioned to me that heating oil, the HO contract in the futures is something I've looked at the chart. I haven't really traded it much, but I know what it is. You said it is what's actually being delivered from this contract is ultra low sulfur diesel. So I know that that's
Yes.
probably it's pretty too many words and too long to replace heating oil, but it's odd to me that it's actually called the heating oil contract, but it's the ultra low sulfur diesel. So talk to us
Well,
about why that
yeah,
is, and also what
you know,
impacts on Main Street is this spike having?
well, I mean, okay, it's sort of an interesting story, but we changed the regulations in this country. We don't use what we called heating oil anymore. We use ultra low sulfur diesel, meaning that the country is continuously trying to reduce sulfur that goes into the atmosphere. So what the contract that actually is deliverable against what we call the HO contract, which is the old heating oil symbol, that's all that's left of it really. It's a middle distillate, which is diesel, and this similar qualities are used for heating and also for transportation, for trucking, for agricultural use in planting and harvesting. And what's happened is that we have all of this new American crude, which is very, very a light API, and that means that is a crude that is produces a lot more light products, meaning LPG, naphtha, the whole distillation process of crude oil has a kind of a continuum of heavy products, which are very sulfurous, like from fuel oil, to middle products, which are diesel, different kinds of diesel, and then all the way up to kerosene and naphtha and light products. But in any case, U.S. refineries and the world refineries are configured for much heavier crudes. And we are producing very light crudes in the United States.
Yep.
And so we tell the story about how creative American refiners are being in trying to get these crudes and use these crudes and configure, and because they're cheap, they're running them. But what's happened is that the products that these refineries actually produce are lighter. There's more naphtha, there's more gasoline, there's more light products. And the heavier products, which diesel fits into that category, it's like a kind of a middle distillate, but heavier than gasoline, though there's less of that being produced. And we're seeing that in the stock levels and the drawdowns, and mysteriously in the spreads. June, July heating oil, I am reminded by a very a client who's been in the markets for a really long time. He said, we have never expired in backwardation in June, July. And he said, but here we are. We're at a premium. June is at a premium to July. Why is that? Because we're just producing less of this right now as a function of the kind of the crude slate that we have, as well as good seasonal demand. We have planting in the U.S. We have harvesting in South America. We have increasing economic activity, which increases trucking and fuel transport. So,
and we're not even in driving season yet.
Yeah, well, we're sort of getting into the driving season here in the U.S. But as far as the diesel, it's interesting because in Europe, diesel is really pretty much the transportation fuel, whereas here, we use gasoline. But so we're moving along in gasoline, but what we need right now is more diesel. So that's kind of just an interesting product story that's an offshoot of what's going on with the.
I think only
2%
of the U.S. cars are diesel driven.
Yep, that sounds about right. Yeah. Whereas in Europe, it's it's the majority, right? I don't know what the percentage
Yeah,
is.
it was sold to us as a green alternative back in the day. So we had the good discounts on taxes and so on. But then came the whole Volkswagen scandal, and then now nobody wants diesel anymore. You know, and there's going to be bans by a lot of countries within the next decade or two.
Final question for today, guys. The OPEC meeting is coming up on June 22nd. Sam, we'll start with you. What do you see coming out of this OPEC meeting?
I, for one, think it'll be ridiculous if they try to change anything right now. If they try to alter so that they end up producing more or whatever, I think that's very dangerous because of the fact that there is a 6 months window now for Iran to wreck the market if they so choose. They could increase their exports pretty much every other month, the way I figure it, because now they reached a new high in April, and I had a look what they were moving, and it wasn't from storage. I actually saw that the storage rose on their export terminal on Kharj Island, which means it implies that either they boosted the production, which I doubt, or they actually cut the refinery run rates, which I actually do believe, because they can always import cheap fuel instead. So I think there's a danger if anyone tries to boost exports, and I think the topic should be exports. It should not be production, because at the end of the day, what will count is the actual crude oil exports. And also, one topic which is never talked about, but also has a massive impact on the market, is the exports of refined products.
Products, yeah.
Yes, because if there's a shortage of one thing, there's a glut of the other. So the balance has to be of all three, limiting the production of crude oil, limiting the exports and of crude oil and refined products. Now, Saudi Arabia, if you look what they're doing, they have cut their exports of crude oil by 500,000 barrels a day year on year, but they're increasing their exports of refined products. And at the end of the day, if you are the leader of any of these countries, the only thing you're going to care about is revenue. You're not going to care how you're going to get the money. You're going to care that you get hold of that money every month.
Pat, what do you think about the upcoming OPEC meeting?
Yeah, I mean, Sam and I were talking about this. I'm in agreement on that. I just think that most likely they are going to try to, maintain the status quo to the extent that they can. And there's so many variables right now in the market. I think, the implementation of this new sanctions is sort of, we think that it's going to be pretty strict, from this new Trump administration, but we don't know exactly. And so I think that's a variable. I think Venezuela's a variable. So, yeah, I don't think that they want to crash the market either. So, most likely they will make some sort of statement that we want to keep the market well supplied. We are interested in stability, and they'll make all those kind of sounds, and and I think they'll try their best to keep things as they are.
Excellent insight today, guys. Pat, we'll stay with you. Where can people find you on Twitter, and give us a website to check out?
Okay, on Twitter, I'm P. Hemsworth, the spelling of my name, which is Phemsworth. And my company is Paragon Global Markets, www.paragonglobalmarkets.com. That's Excellent. Where I am. Yes.
Sam, give us a website to check out, also your Twitter handle and the Twitter handle for Tanker Trackers.
All right, so the website is tankertrackers.com. My Twitter handle is Samir, Samir, _Madani, Madani. So it's Samir _Madani. And the Twitter handle for Tanker Trackers is @TankerTrackers. And we post all of our research and forecasts, EIA forecasts, and any satellite imagery on any ongoing events daily. And so you can visit us on Twitter and on our website.
All right, everyone, you know where I stand. These are two of my favorite follows when it comes to fundamentals in the oil market. Absolutely have to follow them. Both, of course, Tanker Trackers as well, and go check out the website. It's very cool. Sam and Pat, thank you so much for coming on Futures Radio Show.
Thanks for having us. I really appreciate it.
Thank you very much.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.